By the end of this video, you'll grasp the staggering scale of Japan's recent currency battle and why the market remains unconvinced. In just the past 4 weeks, Japan has reportedly poured nearly $75 billion into efforts to stabilize the weakening yen. Yet, despite this historic expenditure, the currency is once again hovering near the critical 160 level. Is the Bank of Japan's strategy faltering, or is the market simply too powerful to control? Currently, the yen is dangerously close to 159.5, teetering on the edge of the 160 threshold that has previously triggered emergency action. This isn't merely a psychological barrier, it represents a definitive line for Japanese authorities. The Bank of Japan confirmed that a staggering 11.7 trillion yen was utilized for FX intervention back in late April. Historically, such massive interventions should create a lasting support level, yet the current trend indicates that relief was only temporary, keeping global traders on high alert for another decisive move from the Ministry of Finance. Now, let's dive into the numbers. Over the past 4 weeks, nearly $75 billion have been injected into the US dollar to Japanese yen market. This figure underscores the Bank of Japan's aggressive stance, especially with the confirmation of that 11.7 trillion yen intervention. Yet, market analysts are pointing out a stark reality: there's nothing to show for it as the currency retreats back toward previous lows. Traders are closely watching a clear resistance level at 159.77. If the authorities fail to defend this zone, it could jeopardize the credibility of future interventions. On social media, traders are increasingly skeptical. Real-time data from X reveals a prevailing sentiment that intervention funds are being swallowed by the market. Observers note that every time the BOJ intervenes, the liquidity is swiftly absorbed, and the upward pressure on US dollar to Japanese yen resumes. As markets remain divided on the likelihood of a rate hike this month, this uncertainty looms large. The sentiment is clear: intervention alone may not suffice if the fundamental interest rate differentials remain so wide. Analysts are now describing the current situation as burning reserves at 159. As the yen weakens, the pressure on Japan's import bill escalates significantly, creating a cycle of emergency demand that ironically increases yen selling pressure. Some experts suggest that capital repatriation could serve as a new accelerant for volatility. The massive outlay of $75 billion indicates that authorities are deeply concerned, yet they are grappling with market forces that see the current yen levels as a buying opportunity, despite the risk of intervention. Despite the currency turmoil, there's a surprising silver lining in Japan's domestic data. Industrial production saw an unexpected rebound of 0.8% in April, surpassing expectations. This uptick suggests resilience in certain sectors of the economy, even in the face of a weak yen. However, for equity investors, this presents a double-edged sword. While some indicators show that stimulus measures are working, the ongoing risk of intervention adds a layer of complexity, leading to a buy the dip but with strict stops mentality in the Japanese stock market. The yen's volatility is directly affecting major indices like the Nikkei 225. The failure of intervention to sustain a stronger yen is exerting significant upward pressure on US dollar to Japanese yen. The resistance at 159.77 has become a crucial watchpoint for global macro traders. A convincing breach of this level could lead to 160, putting the market on a collision course with the BOJ's resolve, potentially with greater trading volume. This situation doesn't just affect Japan, it has broader implications for Asian trade balances and the overall strength of the US dollar. Investors should remain vigilant for any shifts in strategy from the Ministry of Finance that might signal a more aggressive policy change beyond merely selling reserves. For individual investors, the key takeaway is clear: intervention risks are still present, even as industrial data shows improvement. The resolve of authorities is being put to the test, and the swift absorption of intervention funds indicates that the yen's weakness may persist unless the underlying macro drivers, like the interest rate gap, shift. It's crucial to implement strict stop losses. The market remains divided on the potential for a rate hike this month. A surprise move could prove more effective than yet another $75 billion in intervention. Keep a close eye on the 159.77 and 160.00 levels as primary triggers for your risk management strategy. According to AI analysis, we face three potential scenarios ahead. In the base case, US dollar to Japanese yen hovers between 158 and 160, with authorities continuing intermittent interventions to slow the decline without actually reversing it. In a bearish scenario for the yen, a break above 160 could trigger a swift move towards 162 as intervention credibility wanes. Conversely, a bullish scenario would require an escalation of intervention paired with a clear BOJ rate hike signal, potentially pushing the pair back toward 155. The pivotal factor will be the BOJ's policy decision later this month and whether they shift from selling currency to adopting monetary tightening. To summarize our discussion, Japan has spent nearly $75 billion in just 4 weeks, yet the yen remains weak. The 160 level stands as the ultimate test of authority. While industrial production shows a rare glimmer of positivity, the ongoing risk of intervention remains the dominant market driver. What do you think? Can the BOJ halt the decline, or is 160 just the beginning? Share your thoughts in the comments, and don't forget to subscribe for more in-depth macro analysis from Japan.